Good morning, everybody. This is Alex, Senior Account Executive at GDMFX with your European Session Outlook. And we'll start with the North American markets, where it was a busy day yesterday. We had from Canada the Bank of Canada interest rate decision. It was unchanged at 0.5%, and we had ADP employment change for November, 27,000 better than expected. The rate statement from Canada is the following. Exports in non-resource areas were being helped by the ongoing U.S. recovery, a lower Canadian dollar, and the central bank's 2 interest rate cuts earlier this year. But it noted that the resource sector was still struggling with low prices and major job losses. Total inflation, as measured by the Consumer Price Index, remains near the bottom of its 1 to 3% target range, thanks to low energy prices, the bank said. But it noted that business investment continues to be weighed down by spending cuts and resource companies. The bank also said U.S. consumer spending has proven slightly less robust than it expected. In this country, the bank remains concerned about consumer debt levels. Vulnerabilities in the household sector continue to edge higher, the bank said. All right, we also had a speech from Fed Chairwoman Yellen yesterday. It was very hawkish. She signaled that the Fed is all but certain to raise interest rates this month for the first time in nearly a decade, saying that gains in the economy and labor market have met the central bank's goals. Her comments at the Economic Club of Washington amount to the strongest indication the Fed has provided so far that it will take action at the December 15th, 16th meeting. A quote from her, "I currently judge that U.S. economic growth is likely to be sufficient over the next year or two to result in further improvement in the labor market. Those gains, combined with market inflation expectations, serve to bolster my confidence in the return of inflation to 2% as the effects of low energy and import prices fade." We also had the Fed's Beige Book come out. The U.S. labor market tightened modestly in recent weeks with some upward pressure on wages as employers found it increasingly difficult to fill jobs across skill levels, the Federal Reserve said yesterday. U.S. economic activity continued to expand at a modest pace in most regions from early October through mid-November. All right, so the Dow Jones was 100 points down. The NASDAQ was 162 points down. The Dixie is again above 100 at 120 from 99.97. 100.20, sorry. And the biggest mover, USD Swiss franc, 80 pips down. Today's news, Fed's Yellen is going to testify. For Tier 2, initial jobless claims, market PMI composite, market services PMI, ISM non-manufacturing PMI, factory orders month on month, and lastly, we will have a speech from Stanley Fischer today as well. All right, on to the EU markets, where we had the CPI data from the Eurozone come out. The year-on-year was 0.1% worse than expected at 0.1%, and the core CPI was 0.1% worse than expected at 0.9%. The ECB is expected to lift the interest rate on the deposits today and to announce an expansion of the bond buying stimulus program. This would most probably result in a further drop in the price of the euro against a basket of currencies. The DAX 30 is 150 points down yesterday. So for today is the ECB monetary policy statement and press conference, interest rate decision, and we also have EU retail sales data, as well as Eurozone, German, French, and Italian market services PMI. Okay, onto the UK markets. Growth in Britain's construction industry dropped to a 7-month low in November. It was hurt by the weakest expansion in housing activity since mid-2013, according to a survey that suggested the sector will continue to drag on the economy. The market CIPS UK Construction Purchasing Managers Index fell to 55.3 from 58.8 in October. All right, in the Pacific, we had news from Australia. New home sales came out at negative 3%. This is better than previous, which was negative 4%. We had the imports come out at 0%, which is better than previous 2%. Exports negative 3%, which is worse than previous 3%. And the trade balance came out worse than expected at negative 3.3 billion. The Aussie extends its retreat from fresh 7-week highs reached yesterday and fell further into losses in early Asia following the release of worse than expectations Australian trade balance data. Moreover, the overnight slide in the commodity prices and the persisting risk-off sentiment on falling US and Asian stocks curbed the demand for higher yielding currencies and sent the Australian dollar down. Australia is ranked the most favorable country to conduct business by Chinese business leaders, and business engagement between Australia and China is expected to increase over the next 12 months, a new report has found. The last sector for today is commodities. We had the crude oil stocks change yesterday from the US. Inventories rose by 1.2 million barrels last week for the week ending November 27th. It marked the 10th consecutive week of supply increases as crude stockpiles nationwide reached 489.4 million barrels, remaining at levels not seen at this time of year in at least 80 years. Prices went down to $39 per barrel because of this. When OPEC meets tomorrow in Vienna, the world's largest oil cartel is largely expected to leave its production ceiling unchanged above 30 million barrels per day. Gold had a range of $20, trading at $1,052 now. Silver had a range of 30 cents at $13.95 now. Crude oil had a $2 range at $40.53 now. Natural gas is trading at $2.14 at $2.14 at the moment, with a range of 7 cents. Today, we have the natural gas storage change. The report is expected to show a drawdown of approximately 5 billion British thermal units for the week ending November 27. Thank you, everyone. This was today's European Session Outlook. This was Alex with you. I'll see you next time. Goodbye.